I received a comment on a video I made some time ago on an option strategy called the covered call. You can check out the video here for some context on this strategy. So this commenter said, "What if the stock goes to $50 and stays there for years? You are so screwed. Dude, you have to talk about cons also when you make a video." First of all, I want to say thank you very much for your comments. I really do appreciate them as they help me to understand better what it is you want to learn, what questions you may have, and it also helps me to learn how to explain things better. So let's unpack this comment and address some of the concerns that he or she might have. What I interpret is that this commenter thinks that there is a disadvantage to executing covered call strategies, in that if the underlying share price falls and stays low for an extended period of time, then if I had executed the covered call strategy, I would have put myself into a losing position as compared to if I had not used the covered call strategy. Well, yes, that would be true, but only if I had bought the shares solely for the intention of selling covered calls. Basically, if I had seen the covered call strategy as a money-making scheme whereby I can just go out and buy 100 shares of some random stock and sell covered calls on it on a monthly basis to generate a regular stream of income. Please don't do that. What I did mention in this video is that we only should execute this strategy on stocks that we already own. I've done my homework on this company. I think it's a solid business. I think it has excellent growth opportunities. I think it has sound management, strong financials, and the company is worth more than how much I can get it for in the market today. Let's say the market price of the shares is $100. I've done my valuation and I've determined that the shares are actually worth $200. I can buy it today for $100, and while waiting for the share price to catch up with its intrinsic value of $200, I can sell covered calls to enhance my return. Or I can choose to do nothing and just wait for the share price to increase. Now, is it possible that the share price can fall to $50? Yes, absolutely, that can happen. Now let's take a look and see how that outcome may be impacted by the use of a covered call strategy. So in the video, I used a trade on TSM as an example. In the example, I bought the shares at $110 and I sold a covered call with a strike price of $120 with 1 month to expiration. The last time that TSM shares was at $110 per share was on March the 1st, 2022. And let's say on March 1st, I had done my homework and I was expecting the share price of TSM to increase. So now let's compare two scenarios. In the first scenario, I bought the shares and I did nothing. In the second scenario, I bought the shares at $110 per share and I sold a call option with 45 days to expiration with a strike price of $120. So this option would have expired on the 14th of April 2022. In both situations, I paid $11,000 for the shares. In scenario 2, because I sold a call option, I would have collected a premium of $235. Now, if you want to know how I obtained this number, you can check it out in another video which I will upload shortly. Alright, we fast forward 45 days and we find that the share price of TSM on 14th of April had fallen to $98 per share. So what happened to my shares? I'm still holding on to the shares. I have an unrealized loss of $1,200. The call option that I sold with a strike price of $120 now is out of the money. It is expiring worthless. I have a realized gain, a realized profit of $235. So what do we notice here? The share price fell from $110 to $98, and I experienced the same unrealized loss regardless of whether I had executed the covered call strategy or not. When we buy shares, is it always guaranteed that the share price is going to go up immediately? No. Is there a possibility the share price will fall and we may incur losses? Yes. But is that a disadvantage of the covered call strategy? No, I would have experienced the unrealized loss regardless of whether I had executed the covered call or not. In fact, by executing the covered call strategy, it actually was an advantage to me because I was able to minimize my losses by almost 20%. But is there a disadvantage to executing a covered call strategy? Yes, there is. I uploaded this video on August the 21st of 2021. After that day, TSM shares was next at $110 on October the 4th of 2021. The share price then went to the highest price of $145 on January 13 of 2022. So if on October 4th of 2021, I had bought shares at $110 and sold a call option with a strike price of $120, what would have happened? Now the share price of TSM went above $120 and stayed there for 3 months. So I would have been obligated to sell my TSM shares for $120 and I would have missed out on the opportunity to sell the shares at $145. I mean, of course, I have no idea that the share price was going to go to $145. I have no idea if the share price was going to go even higher or if it was going to come back down from there. But on January 13 of 2022, I definitely, in my greedy human nature, would have thought, oh, I missed out on that opportunity. I could have sold it for much higher. Why did I sell that call option and put myself in a position where I was forced to sell at 120? See, the thing is, I still made money. I bought the shares at 110, I sold it at 120, and I even made money from selling a call option. But in my mind, I could have made more money. I missed out on that chance. That is the disadvantage of the covered call. Alright, so the conclusion is this. The covered call is a strategy we can employ to enhance returns on stocks that we already own. We can use the covered call to generate a return on stocks that we have already bought while we're waiting for them to go to prices that we have projected that they will go to. We make these projections based on fundamental analysis of the business of the company and valuations we have done based on the company's financials. Now, even if the share price falls, if this is still a solid business, if it still has strong financials, if it still has excellent growth opportunities, then I think there's really nothing to worry about at this point in time. You're not screwed. Relax. Short-term price movement, short-term volatility in the market is very, very common and is largely driven by emotion. But once again, we do not buy shares randomly just for the purpose of executing option strategies that can generate income or generate returns. If that is your strategy, you're likely going to be screwing yourself over. Alright, that's pretty much the gist of this response video. I hope that it helps to clarify some of the concerns that some of you may have about the covered call strategy. Once again, I really do appreciate your comments, so like, comment, subscribe. If you found this video to be helpful, let me know if you have any further questions and how I can further or better explain these concepts. I'll see you in the next video.